But good evening or good afternoon, depending on where you are in the world, everybody. And thank you all for joining this evening. This is 2024's last webinar session for Joseph Mews. We've done them consistently every month through the year. And I think, well, hopefully the feedback has been pretty good, and our clients have found it a pretty useful tool to learn about the market. And we've always segregated them into different topics, from mortgages, sometimes to letting, sometimes to the UK market, sometimes more product focus. And so we thought it would be fitting at the end of the year to provide a sort of more of a interactive live Q&A session with a panel of guests who can cover basically all the parts that you really need to consider when looking at property investment. And so when I say all, let's say three of the parts of what you need to consider are your mortgage options, tax advice, and the actual letting and rental and management of your property. So it's a delight to be able to invite both of these three guests on today. We have Lawrence Hodgens, who we've done a webinar with previously, Sophia Kazmi on the mortgage side, who we've done various webinars over the years, and the same with Raj Bedi, who is our expert on the letting side. So we thought for the end of the year, we would get everybody together and, as I say, do a sort of more interactive live Q&A. So the whole premise of this is that as we're going through, and if you have any questions now that you want answered, is to put them in the chat box at the bottom. You'll see there's a Q&A section. You can write your questions in there, and then we'll answer them as we go along. So a lot of you have sent questions in already, which is fantastic. So we're going to go through some of them, but please also just put any other questions that you have throughout the webinar, and we'll answer them and make it as interactive as we possibly can. So we'll start with a little bit of an introduction about Joseph Mews. It's going to be very quick. I know a lot of you know who we are. We obviously founded a long time ago now by the gentleman on your screen, Andy Foote. He started the business with the idea that his own experience from investing in property was pretty poor from a customer service experience, and he wanted to change that, partnering with proper developers in the UK that we knew we could rely on, but also helping that process, whether you're based 6,000 miles away from the property or 3 miles away from the property. You have a level of service that's specific to you, and all of your requirements are understood, and you have your hand held. And so that's how the business started. And as I say, that was a long time ago now, and throughout the last few years, we built a huge portfolio of properties, all specific to the UK. Go to the next slide, please. So Joseph Mews are big advocates for the brain tumor charity. The reason being is that Andy, the gentleman that you saw on your screen, he has been a pretty successful guy in the real estate world, but he will always tell you his greatest success is what you see on the screen in front of you there, the brain tumor charity. It is in fact the largest brain tumor charity in the world, and it was founded by Andy. And the reason he founded it is because his son, Joseph, tragically passed away from a brain tumor aged just 9. And when that happened, Andy wanted to change that outcome for other families, and it's been an amazing success. The charity changing the survival rates from 15% to 77% today. So we're obviously big advocates. It's where we get our name from. Joseph Mews is a Mews house is a type of property, and it's our head office in Birmingham, in the UK, which is called Joseph Mews, and we named ourselves after that. So it's a sad story, but it's an amazing story as well. And you know, our clients and investors have always been great supporters of the charity. So if you would like to get further information on that, or ways in which you can contribute, obviously they're on our website, and we'll send them over to you. Next slide, please. So in terms of the actual units, our track record and what we've delivered, 40 developments around the UK, 3,500 units that we've actually marketed, sold and delivered, and just under £600 million worth from a residential property perspective. So it's a big track record. It's been obviously over a long period of time, and that's important, you know, who you're investing with, because obviously the fact that we've done this so many times, all with clients all around the world, is kind of testament to how we can build these webinars today, and we know the right partners to use for each step of your property investment. Next slide, please. So when it comes to our partners from a development point of view, we're obviously very specific about who we work with. We want to work with developers that we can rely on. We don't just work as agents. Typically, we work as exclusive partners with developers. The way in which that works is we partner with a developer. We commit ourselves financially from a distribution level, from the appraisals, from the pricing, from everything. And we offer that developer the opportunity to obviously have distribution all across the world to our network of investors. And so the important point here, I suppose, is to mention that we're not just an agent whereby if something goes wrong with the development, that we are only hurt reputationally, we're actually hurt financially. And it's not just a reputational hazard for us, it's something that affects us financially. So we need to be incredibly sure of the partners that we're dealing with from a development perspective, and we only work with the best. So we're not going to talk about product today. If you do want any questions or answered on developments, or you'd like some information sent on developments, then please just ask afterwards. Next slide, please. So I guess the customer journey is kind of what's led us here today, is understanding the different boxes you need to tick as you go through this investment journey, from reserving a property to going through the legal side of things for a lawyer who's representing you. And then you go through the kind of customer care, the handover, completion, and after sales. And through those different steps, you obviously need to consider mortgage options if that's an option that you're taking. 95% of our clients take mortgages, so inevitably it's a big part. You need to consider your tax position, regardless of where you are from or where you're based in the world. That will obviously, there'll be different implications relative to your own, as well as the generic rules. And then obviously it's the rental and the management, which, is we always refer to as the cornerstone of property investment. If you don't have your property rented, then the whole kind of the model falls apart. What we want is to achieve a model whereby the rental income is coming into your account, the mortgage is coming out of the same account, but you're still in positive cash flow. And the only way that we can achieve that is by consistently renting and managing the property. So all of them are as important as each other. They all kind of work together, but separately. And we are lucky to have the partners that are on today, as well as others from a legal perspective that we've worked with for many years and know their strengths. So that's the kind of premise today, is this customer journey, understanding each step of it, and guiding and teaching our investors of the most efficient ways of investing into the UK. Next slide, please. So as I mentioned before, please feel free to put any questions that you have in the Q&A box at the bottom, and we'll endeavour to answer them. Next slide. So the panel discussion is what we're going to come on to now. As I said, we've had many questions that have been sent in. We've got many more that we expect to get during the webinar, so please do ask them. But we're going to start off with a poll, actually. So hopefully this will work if technology doesn't fail us. You're going to get a screen that will come up and give you a poll question. So the question is, what is your biggest concern when investing in UK property? Number one, is it financing and mortgages? Is it tax and legal implications? Is it rental market performance? Or is it development delays? I know that there can obviously be more than one, but it's interesting to know what your biggest concern is, and the audience that we have today. So if you'll please click that, and the results should come up shortly. Here we go. Right, so the majority are financing and mortgages, and then we have 17% tax and legal implications, and then rental market performance, and no votes for development delays, which is interesting. But I guess that kind of leads us on nicely to our first question, which is actually for Sophia, who is our mortgage expert with us today. As I mentioned, that we've worked with for many years. Sophia is based in the UAE, has clients all over the world. And one of the questions that we've had, Sophia, hi Sophia, by the way, and thanks for joining today. The first question that we've had is actually related to mortgages. And it's asking, with the Bank of England's recent interest rate cut to 4.75%, how is the mortgage market responding, and what should potential buyers be aware of?
Well, I think it's an interesting one because we saw the base rate go up quite a bit and quite quickly a couple of years ago. And with that, we saw a lot of lenders increase their rates quite significantly and quite quickly. But we've recently seen the base rate drop consecutively, and more recently down to 4.75, and it is predicted to continue to go down. I was reading, I say that Goldman Sachs are predicting it to continue to go down into 2025, near to 4%, and some economists even predict that that's going to go down to threes as well. So with that in mind, we've seen a lot of lenders now not just come back to the market, a lot of lenders that pause their lending, but a lot of lenders now reduce their rates. Anyone that's been on variable rates has seen automatic drops in their rates automatically, because those are mirrored by the Bank of England base rate as an example. anyone who's taking up new rates, such as new fixed rates, it takes a little bit longer for lenders to normally adjust their rates because those are normally impacted by swap rates. So it takes a little bit longer. But across the board, we're seeing rates continue to go down, and I think that's the general prediction over the next couple of years.
Do you see a sort of pent up demand that people were waiting for this inevitably to happen as inflation came down, that interest rates would come down? Do you see that, or do you think we're kind of coming into that as we go into 25?
I think I think the UK has always had that demand. So, and a lot of people, regardless of interest rates, there's always been that huge demand to invest in the UK, and especially if you're investing from a country that say and you're benefiting from the exchange rates, and we always say, as you say, Johnny, too, it's your time in the market, isn't it? So yes,
Mm.
fine, maybe you're saving 25 basis points by holding off 6 months, but you also missed out on 6 months of that rent and 6 months of that capital appreciation in that development or in that area. So
Yeah.
I think, yeah, I don't think it's necessarily been so much pent up. I think that all across the board, generally, people have still been investing and people will still continue to invest in the UK.
Yeah, I think it's a good point as well about the sort of longevity approach of this, is that it's not a quick sort of gain here, where UK property investment is about the longer term. And inevitably, even if you buy in I can speak from my own experience of buying a property that as you know, Sophia, my initial mortgage rate was 2.5%, and it went up
Yeah,
to 8.6%. So that's inevitably going to fluctuate over time, but it's about looking at the bigger picture, and making that sort of count, I suppose.
yeah, exactly.
That leads us on, I guess, to our next poll question. And hi, Lawrence and Raj, by the way. We've obviously got plenty of questions for you guys as well. So, but thanks for joining. The second poll question is, again, with regards to mortgages, is what do you think is the biggest challenge in getting a mortgage for UK property investment? And this is something that I know a lot of our clients, having been an overseas resident for 9 years now and dealt with clients all over the world, it is a huge worry people have. Can I get a mortgage? Am I going to, be left holding the baby at the end of this? And these are some of the kind of worries that people have. Lack of credit history in the UK. Some of our
Hmm.
clients have never spent much time in the UK, let alone have a credit history. Opening a UK bank account, limited lender options, complicated application process. They're all justified worries. But I think that there is this kind of unnecessary worry sometimes when it comes to mortgages, and it's just through a lack of knowledge and understanding, which is kind of what we're trying to help, I suppose.
Absolutely.
But
It's an interesting one that the most common answer is actually lack of credit history as well, because that
do you
seems to be the
find
general
that?
consensus. If you can see the results have come up, but that's 75% of people, and that tends to be the general consensus across the board. Whenever we've done webinars and whenever we've done these polls, most people, their biggest concern is lack of credit history in the UK, and it's a surprising one because the simple answer is you don't need to have a credit footprint in the UK at all, and you don't need to even step foot in the UK throughout the whole process, application all the way through to completion and even beyond completion when you've got the property. Raj will be there to manage the property for you. So there's no need to go to the UK at all. Banks don't require you to have a UK footprint. Sometimes they may want you to provide a credit report from where you live locally in the UAE or in Nigeria, wherever you reside. But again, that's not always a requirement at all.
And opening a bank account in the UK is something that is part of the process of facilitating the mortgage, right?
Yeah, absolutely. So dependent on who you arrange the mortgage with, some lenders might offer the account for you. So they'll open an account for you, which it can take a couple of days. If not, we can arrange an account opening for you. Some lenders don't require you to have a UK bank account, so you can use an international bank account if you want, if that makes most sense. You can arrange that for you. So there are different options available. But again, you don't need to have that at the outset to start the whole process.
Absolutely. Look, we'd always encourage, everybody's situations are different, but we'd encourage you having a free consultation with Sophia to understand, what your options are. But I guess the main point to highlight here is, from my experience over the years, that even British expats or British passport holders that are living overseas aren't aware that they can get mortgages in the UK. So, even if you're not a British passport holder, then you're probably even, your mindset is even less likely that you're going to get one. But there are options, and depending on your circumstance, but it's a good idea to have that consultation and see where you stand. Lawrence, I'm going to bring you into the picture here. Thank you for joining us, Lawrence Hodgens, who we've worked with for a while now, who's our tax expert. And, tax is something that, is ever changing and ever relevant to all of us. And it's great to be able to work with Lawrence and for Lawrence to be able to guide our clients on what they should and shouldn't be doing. Hi, Lawrence. I think a first question to start with here is we had the budget, obviously 31st of October, that everyone was concerned about. I think, from our side, it wasn't necessarily as bad as we thought it could have been for our investors' perspective. But the increase in stamp duty rates for second home buyers is expected to influence the market activity. How should investors and buyers prepare for this change, is one of our questions that we've had.
Well, you should try to take advantage of the period we have between now and the 5th of April, because from 6 April onwards, you've got a 2% increase in the stamp duty. So you might want to, if you have the capability, you might want to take advantage of it now rather than wait until later. So it's important to make a decision, stick with it, and act quickly.
Yeah, so to sort of, I guess, clarify the benefit here by investing before the 6th of April is that you pay 2% less on your stamp duty amount, right?
Yes.
Exactly. Okay. So no, that's interesting to know. I think a lot of people that are going through the process at the moment are keen to sort of rush it along as quickly as they can to sort of to make the most of that. Look, I think again, it's kind of worth pointing out that looking into the future and looking at inevitably there will be more changes with changes of governments, and so we never know what the future holds. But that is something that we are in control of at the moment, that you can help yourself slightly. We're going to ask another poll question now, which I know that is important, Lawrence, that you always want to ask, and it's interesting to understand, particularly with clients overseas, is have you ever filed tax returns previously in the UK and obtained a UTR, which is a unique taxpayer reference number? So it'll be interesting to see if you have. And that's an important part of your initial conversations, right, Lawrence, when you speak to clients?
Yeah. So if you want to invest in rental property in the UK, you'll have an obligation to file a tax return. Have you filed tax returns before? No.
Okay, so look, if we look at the answers here, the majority are, I'm not sure what a UTR is. Do you want to explain that, Lawrence, perhaps?
So a UTR, as Johnny said, is a unique taxpayer reference code. And this essentially is your tax identification number, which you need before you can file a tax return to declare your rental income. Whenever earning rental income from UK property, you're obliged to file a tax return to declare how much you've received and how much cost you've incurred that can be offset against the income. And then whatever remains could be subject to tax in accordance with UK tax legislation. So if you have lived in the UK before, you probably have a national insurance number. If you have a national insurance number, it will, like a social security number, it will be a straightforward exercise for you to obtain a UTR number. If not, then it can be a bit complex. But if you appoint a tax agent to do so, such as myself, then a tax agent will be able to get you one within a couple of weeks. And then once you have a UTR number in place, then it's a matter of making sure you file a tax return within the reporting process. The tax year runs from the 6th of April to the 5th of April, and then from the end of the tax year until 31 December of the 31 January of the following calendar year, you are required to file a tax return within that time frame to avoid late filing penalties, and I can help you with that, etc. And
okay. We've got an interesting question here, Lawrence, which I'm not sure if you can help with. Somebody's asked, how do I go about finding my national insurance number? I had one in 1989, 1990. It's a good question, because I think a lot of people that have lived overseas for a long time might find the same.
You can go online. There's a web site, how do I find my national insurance number? And you should be able to find it from there. If not, then you would just make a phone call to the Department of Work and Pensions. But you should be able to obtain it from the internet.
Okay, perfect. That's good to know. I think a lot of people might find that, especially nowadays, especially moving around. Okay, thanks for that, Lawrence. And so just to clarify, so even if you don't have a national insurance number, you've never lived in the UK, you can still help clients with getting
Absolutely.
Yeah.
So there's no need to worry. You know, they even though they'll have a tax obligation by law to declare the rental income, there's no need to worry. It's a formality. It can be dealt with, and we'll help you with the process, and we'll take care of preparing the tax return, filing the tax return for you. And as your tax agent, we can liaise with HMRC. We can have online visibility of your HMRC account. And if there's anything untoward or any dialogue required with HMRC, we can take care of it on your behalf, etc., once the authorization is in place. So it's a formality, but it shouldn't hold you back from making the investment that you want to do so in UK property.
And look, the same as I mentioned with Sophia here is that everyone's situation is different to some degree. So if you would like to speak to Lawrence, obviously we're going to share details of all our panelists today and have the opportunity to get in touch. So speaking of panelists, Raj, you've been patiently waiting there. So again, thank you for joining. The rental market, and as we said, renting in the UK has its complexities, and it's often a concern is about becoming a landlord and people thinking, how am I going to manage this, particularly if they're living overseas? You know, I'm living 3,000 miles away, 6,000. Who's going to manage it? How am I going to be sure that I have somebody renting, particularly when you're taking on debt and you're saying, I'm going to commit to taking this mortgage for 25 years. I need to make sure that I'm having someone to rent that. So I think before we ask our first question, we'll do another poll and ask, what is your biggest concern about becoming a landlord in the UK? So it'll be interesting, firstly, to see what responses we have here. So the first one is finding reliable tenants. The second one is managing maintenance and repairs. Third one is legal regulations and paperwork. And the fourth one is void periods. Raj, if you had to guess, what would you guess will be number one here?
I think people think finding reliable tenants. I think that'll be the number one.
Let's see if your senses are right. Oh, well, sort of.
Pretty even.
Pretty even. So finding reliable tenants, managing the maintenance and repairs, and then void periods. I think void periods, from what we mentioned earlier, are often a worry. It's something that I hear a lot from our clients, is for the reasons that we mentioned about paying off your mortgage, or even if you're not taking a mortgage, to have that consistent income. But reliable tenants is another one. And I guess, it's a good question to ask, Raj. I mean, what would you say to somebody that is worried about them finding reliable tenants?
A lot of, depending on where you invest, if you get the location right, you get the right development, then a good property will attract good caliber of tenants. So that kind of that will massively help you find a reliable tenant by just investing in the right place. And then the other side of it is, when in the UK, when a tenant is renting a property, they have to go through referencing. And that basically prevents an agent from renting to the wrong tenant on paper. Of course, you can never judge it, and there are instances where a bad tenant could slip through referencing and could get past referencing, because on paper they are a good tenant, but actually they're not. But it's very, very rare to have a bad tenant. 9 times out of 10, 99 times out of 100, you've got a tenant that pays the rent, pays on time, and looks after the property. But yeah, I'd say the referencing is an important part of making sure you've got a reliable tenant.
Yeah, I think it's something that's interesting, particularly. Sorry, go on, Lawrence.
Johnny. Yeah, can I just say, Raj, in my experience, and I deal with a lot of landlords, very few have had any bad experience. Very few. I can agree with that as a tax advisor to many landlords. Excuse me, Johnny.
Yeah, no, I appreciate that. Thanks, Lawrence. And look, I would say the same. what I would say is that a lot of clients that are based overseas perhaps don't understand this referencing process in the UK. You know, where in Dubai, where a few of us are, you don't have that referencing process. You typically pay more in advance because of that. So you'd pay perhaps 6 months and 6 months. And I know a lot of parts of the world are the same, but Raj, it would be good, I think, maybe to explain what is the referencing process. What do you ask from a potential tenant before you allow them to rent the property?
So there's three elements of that. The first one is employment checks. So checking they're employed, checking they're on a permanent contract, how much they're earning, how long their job's been, etc. So there's that side of it. And that's more for the affordability. And they need to be earning a certain amount to be able to afford the rent. The other part of it is getting a previous reference from their previous landlord or agent. So just making questions are asked like, you know, have they paid the rent on time? Have they paid it in full? Have they caused any damage to the property? And the third element is the credit history. So just making sure that they haven't got any, you know, CCJs or any bankruptcy or anything like that. And them three things, they are quite stringent, and sometimes tenants do think it is a bit over the top. But at the end of the day, that's the process. And, you know, as a landlord, you'd probably want it to be over the top. You'd rather go that bit extra to make sure you prevent, you know, a bad tenant slipping through the net.
Yeah, 100%. I mean, having done it myself in the UK, it can feel quite invasive. And you think, I'm just trying to rent a property here. But, you know, you're asked, yeah, every bit of personal information. But as you say, as a landlord, you wouldn't have it any other way. It's great. And look, human beings are human beings. You can't predict everything, but you can make the odds pretty good by doing a thorough referencing check. So I think that's important. A lot of our overseas clients aren't aware of that situation in the UK. To come back, please keep asking your questions, by the way. We've got a few coming in now. We've got one more. Thanks, Raj, by the way, and we'll come back to both yourself and Lawrence. We've got another question for Sophia. What can I pre-qualify for a mortgage before identifying a property as a non-resident of the UK?
Yeah, absolutely. And whether you're a resident of the UK or a non-resident, you can pre-qualify. We always have these conversations with clients, don't we, Johnny? Even if it's 2 years in advance of the property completing, we have those conversations. We go through a fact find where we gather details on one's finances, their income, what type of mortgage they're looking for, so we can look at how best to structure that purchase. They'll have a conversation with potentially Lawrence to look at whether they buy it through a company, you know, what makes the most sense. We'll then go away and research the options and give them an indicative term sheet. And sometimes, depending on the lender, we can also get a headed decision in principle or agreement in principle from the lender as well, which we can then give to the clients. And so, yeah, I think it's really important to have those conversations, however early it is in advance, because you're able to ascertain whether you're able to get a mortgage and what it looks like. So it's a really useful tool.
Exactly. We always encourage any client that we speak to that, you know, whether they're looking at property that's off plan, that's completing in 12 months, whether it's property that's completed, the first port of call we always say is have a call with Sophia. It's a free consultation, and she will be able to give you these indicative terms and let you understand, you know, what your options are. And then you can go forward with a bit of peace of mind, knowing that you do or you don't have options. I mean, on the back of that, we've also got a question, Sophia, from Mark, who mentions, do the banks approve 80 to 90% mortgages to somebody who is self-employed and 60 years old?
It depends. So it depends on where you live. It depends on what passport you hold. It depends on how you're buying the property, personal name or limited company. There are so many different ways. I mean, to answer the question, yes, there are potential lending options to 90%, but often that's more for UK residents. Outside of the UK, you're probably looking at more 80% maximum, anywhere between sort of 70 to 80%. So but it just depends on how you're looking at structuring it.
Yeah, we would always advise, you know, having obviously done this for a while and seen clients, particularly overseas, that you should budget for a 70 to 75% mortgage, really. 80%, you know, there are options, as you say, Sophia. 90% is pretty rare unless you're in the UK, as you mentioned, isn't it? So it's good to kind of look at
Yeah,
the 70,
absolutely.
75. But again, if you get in touch with Sophia, you'll be able to understand in your position. Raj, got a question for you about the changes in landlord and tenant laws. Somebody has asked, very worried about the changes in landlord and tenant laws. Will landlords no longer have security of tenure with ASTs? Therefore, are we better off doing only short lets?
So the government are proposing and will be introducing new laws, most likely from next year. Nothing's set in stone, but the early kind of indication of how it will look is essentially, at the moment, tenants sign for a fixed term. Most common is 6 or 12 months. What will happen going forward is all tenancies will start off rolling, whereby the tenants won't be able to serve notice in the first 6 months of a tenancy. So, although it's called rolling, really what it is a 6 month tenancy that then goes rolling. At the moment, if as a landlord you can serve your tenant a Section 21 notice, whereby you can give your tenant 2 months' notice to vacate the property, and you can do that for any reason. That one of the big changes will be that there'll only be certain reasons that you can get your property back from a tenant, and the two key ones are you're going to be moving back into the property and you're going to be selling the property. So one of them two. Another one, obviously, if the tenant's causing issues such as not paying rent or um, and nuisance issues, things like that, then of course you can get the property back. Now that is concerning for landlords because at the moment they don't need to give any reason; they just can get their property back. Whereas now there's going to have to be certain reasons. But what I would say to that is, how many landlords out there give their tenants notice for no reason? 9 times out of 10, it's for they're moving back in or they're going to be selling the property. So, in my opinion, and this is going to have a massive impact on not just landlords, but more important, like the agents. Really, we're managing the properties for the landlord, so this has got a massive impact on our business. But it's not something I'm worried about. It's another law that the government are introducing that doesn't seem as very favoured to the landlord, but I don't think it's going to have that much of an impact.
Yeah, I agree with that. But I can understand the worry from investors and owners, but as you say, I think the actual the serious implications are pretty low. Another question, Raj, just on the talking about tenants not paying rent. There are insurance policies that you can take with regards to that, right? In terms of, yeah, do you want to explain
So
that?
yeah, so one of our actual USPs is any tenant that we put in your property that goes through the referencing stage, we actually pay for. When we pay the referencing provider, we actually pay for an insurance as well that covers if the tenant wasn't to pay the rent, all your legal costs to evict that tenant would be covered, and your legal costs might come to about £1,500 to £2,000, and basically you wouldn't have to pay anything. So that's just something, a USP that we offer. But on top of that, let's say your tenant isn't paying, all your legal costs are being covered, but actually you're not receiving rent during that period, and that legal process might take 4, 5, 6 months, maybe more. So what you can do is buy a rent guarantee insurance. Typical costs can range, depending on the rent of the property, but from £160 a year to maybe £250 a year. So you're talking, £15, £20 a month. And that
That's
gives
very nice.
you basically security that if you're not getting the rent, the insurance is going to pay your rent.
Yeah.
So I'd say it's definitely worth considering, because I mean some people decide, well, I'm not going to take it because the chances of that happening are so low. But and that is true. It doesn't happen very often where you do need to claim on it. But for £160 a year, you've got that safety net and that peace of mind. So why not look at it?
100%. I think for me is, with my own investment head on, as well as obviously being in the industry, I think it's a no-brainer really for the upside that it brings, particularly when you're taking a mortgage. Raj, lastly for you, just another quick question that we've had. What would you say is best for investing if there is one, a 2-bedroom, a 1-bedroom, or a studio?
Okay, so I do get asked this question a lot, and all property types are very popular. There's no kind of right or wrong answer. You can't go wrong with any type. But if I had to pick one and commit to one, at the moment, in the last couple of years, I would probably say one beds are probably the most popular from a rental side. And the reason for that is down to affordability. With rents increasing and kind of going through the roof, tenants are obviously not as able as they were to afford a 2-bed, as they used to be able to. I remember 6 years ago you could get a new build 2-bed apartment in the city centre for 900, £1,000. That's, now you might be looking at 1,500, 1,600, maybe even more. So it's a lot more rent for someone to have to pay. So then they're looking at maybe getting a 1-bed for a lot cheaper. So but that's the reason I'd say a 1-bed, just from the affordability perspective.
Yeah.
But
Yeah, I
yeah,
think
on a resale perspective, I'd probably say they all do quite well. I'd probably say studios are a bit more difficult to sell from a resale perspective, and that's just because you haven't got as much of the owner-occupier market to sell to, because owner-occupiers are they're less interested in studios, because studios are kind of more aimed at tenants that are more kind of short-term, going to live there for a
yeah.
year or two as a stepping stone sort of thing.
Absolutely. Yeah, that's why, look, with our developments, we tend to just focus on 1-beds and 2-beds. That's kind of for our consistent tenant demands. Those seem to be the best. So yeah, and when you've got to look at the exit strategy as well, as you say, Raj, the studios are a little bit more difficult. That kind of leads us on nicely to the next poll question, which is, what type of property are you most interested in investing in? So if we bring that up. And there are the options: 1-bed, 2-bed, 3-bed, and studio. So let's see what we get as answers here. There we go. So yeah, 1-bed and 2-bed. That's what I found over the years as well, is as you said, Raj, from an affordability perspective, not just from the renter but from the investor. The 1-bed is more affordable. And you do, young professionals, professional couples, particularly in city centre areas or commuter areas, that does seem to be the big demand, the 1-bedroom apartments. So it makes sense. Lawrence, we have a question for you that has just come in. Is it better to invest as an individual or through a company structure? The age-old question.
Yes, age-old question, yes. No, it's infinitely better as an individual. And you'll find that mortgage costs will be cheaper as well as an individual. They might be inflated as if you buy through a company. But at the same time, if you're going to have only 1 or 2 or possibly 3 properties, it's still better to have it in your own name. If you do it through a company, you have a lot of compliance procedures, etc. Through a company, you offset the interest entirely as a cost. You're taxed on the bottom line. But as an individual, you may find that it's easier from a reporting perspective to manage it through privately in your own name. If you do want to invest in multiple properties, I would recommend a company, but I'm happy to discuss that on an individual basis. But as an individual investor for the first time investing in rental property, I'd recommend doing it in your own name in the first stage.
I think we'll put the poll up now and to see what people say. Do you prefer investing as an individual or through a company structure? But one thing, Lawrence, I think we find particularly overseas that people perhaps aren't aware of, that there's I think, what is it, 130 countries that have double taxation agreements with the UK. And if you are both a citizen and a resident nowadays in those countries, or if you're a passport holder from an EEA country as well,
That's right.
you do get that benefit. So one of the benefits of a limited company and buying through a company structure is that you pay corporation tax, which is 19%, and not the higher tax bracket if you were already earning income in the UK, but you don't get the use of that income free
the annual tax-free allowance. That's right.
Exactly, which is what 12,570.
That's right. And so from a corporation perspective, you have tax on the bottom line. So it'll be rental income less all the associated costs. While with on a personal basis, your income tax is assessed after entitlement to the tax-free allowance of £12,570. So if you're not expecting to make a profit of more than £12,570, why create a company? And it gives you additional administrative costs and additional rules and regulations to observe. It's much simpler as an individual.
Exactly.
But
And
I see that people are going for the individual ownership.
Exactly.
But for a limited company, I recommend it certainly when you are buying multiple properties. Sophia will tell you that mortgage lenders prefer if there's multiple properties being targeted, then they would prefer a limited company. Isn't that right, Sophia?
Yeah, absolutely. If it's multiple properties, then perhaps a company makes the most sense. And the lenders prefer that because you can sometimes just facilitate into one big loan, and put, and just do the whole portfolio as one big, one mortgage essentially.
But also the security as well. I mean, the collateral. If one, you explain further.
One doesn't. Yeah, absolutely. They've got multiple securities they can potentially take a security over. In general, though, as you said earlier, Lawrence, though, mortgage rates and generally are more preferential when someone looks to buy in their personal name as opposed to in a company. So if you're looking at buying 1, 2, or even 3 properties, that's generally the route that I suggest most clients go down to begin with. Absolutely.
So the rates are better in your own name. The LTV amounts, are they about the same, 75, 80, or what do you find there?
Yeah, they normally stay about the same. So you're probably still looking at about 65 to 75% loan to value, whether it's personal or limited company. You do have more options for a personal in general. So because of that, sometimes you can leverage against that and squeeze the loan to value higher. But across the board, generally, you're probably looking at another 1% higher when you're going down the limited company route in terms of interest rates.
And the fees, obviously, Lawrence mentioned as well that you tend to pay more fees when you're buying through a company.
Yeah,
Okay.
so where you might pay 1% for a standard lender, you might pay 1.5%, 2% sometimes for you're buying in an SPV. So you have to look at the cost to make sure it makes sense overall, even with additional costs. Yeah.
I think the moral of the story is do your research and for your own capacity to understand what's going to suit you. But I think more often than not, particularly if we talk about our property types as well, where we look at lower priced properties, that naturally the income is lower, although the yield is higher, the income is lower, which means that you don't necessarily go into these higher brackets, which means that particularly if you have the double taxation agreement and you have that tax-free allowance, then it does make sense to do it, more sense to do it in your individual name for that wide variety of reasons. But again, that's a conversation to have with both Lawrence and Sophia. Which you can
It's also, Lawrence, isn't it? Even if someone's buying, let's say you're buying with 2 applicants, then you can split that across 2, can't you? So then again, even more of a reason. Yeah. So even more of a reason.
And then if it's jointly owned and both of you have entitlement to the tax-free allowance, then essentially £25,000 of rental income is tax-free. So you're taking
a huge amount, really.
You're taking full advantage of your entitlement to the tax-free allowance, investing at the same time in UK property, getting rental income and not suffering any tax, even though you're living overseas. It's quite advantageous. And You lose that advantage if you do it through a company.
Exactly.
Yeah.
And you'll be surprised how many countries have this double taxation agreement. So a quick search into Google, whatever passport you hold, just type it in and it will tell you. But yeah, the majority actually do, which is great and often unknown to our investors. A quick one for Raj, so that you don't sit there bored. We have a question: Are there caps on service charge increases in developments that have amenities?
So no, I'm not. There are no caps on service charges. Essentially, the service charge amount is determined by how much is being spent on the management of the building and the communal areas, cleaning, etc. So yeah, there's no kind of cap. But what I would advise to anyone investing in an apartment is, when you're informed about the service charge, just maybe ask a few more questions around it. So maybe find out, is the service charge, are they building up a reserve fund where if there's, an expensive out the blue issue that is going to be covered within the reserve fund. So that's a question you might want to ask. And then just also maybe find that you can actually ask for a budget of how the service charge has been put together. So again, you can have a look at that and just see kind of for yourself where that figure has come to.
Yeah, 100%. And look, but I think it's an important point to make, particularly for clients that live overseas, where in certain places, service charges can suddenly get completely out of control with no justification. What's important to mention is that in the UK, you're governed by the ombudsman to a degree, and you have to illustrate the fairness of how or why you're increasing that service charge. Am I right, Raj? So if
Yeah.
you are seen to be doing something that isn't justified, then as that service charge provider, then you can be in real trouble and struck off not just that property but other properties within the UK.
Absolutely. So the service charge, it is literally just what is being paid on the maintenance of the building. So it's, a company can't just increase the service charge for no reason. The other thing is the management companies that are managing the service charge, they have to get quotes from, let's say, I don't know, there's an issue with the lift. And that needs repairing. They have to get a few quotes and put it out for tender to make sure that they're getting the best deal. So
Not that
yeah,
they're choosing a partner that they want to,
yeah,
but
yeah.
in the business. Yeah. So it is important that for those of you that are listening, that are living overseas, that it is different to other countries. Even the US, I know, is completely different to how the UK works. You are sort of governed in that way by the ombudsman, although it's not officially regulated. It's sort of to a degree is. And another point that I would say on it is from our developments. Our latest two launches with the Secon group, they have amenities are kind of at the forefront of our decision making when building these properties now, because we know that there's such a demand for them, that the tenants are staying at home more because they're working at home more, and it's the culture and the working life in the UK has slightly shifted since COVID. So we're conscious of that, and one thing that we've been able to achieve with these two developments that we've just launched is that you actually have a share of the freehold, and that has a share of the freehold, which has various benefits. What's the opposite? Well, the 99.9% of apartments in the UK are leasehold. Freehold is typically when you buy a house in the UK, but these developments have a share of the freehold, and there's various benefits, but the main benefit from that is that the service charge is actually managed and governed by the owners of the property, by you as the investors. And typically it will be the people that have bought, that are living in there themselves, that are on site every day, and they will be the ones in charge of what the service charge is and how much it is. So you're never ever going to have it being used as a sort of profit-making scheme. It's only going to be dictated by what is necessary and what is going to keep the building looking great and livable, but not by profit and raising charges, as hard as that can be. So that's a really important point. And obviously, if you'd like some further info on that, then please do ask. But it's a big plus. Got a question for Lawrence. Can I claim the cost of managing properties like admin and communication tools against my tax liability?
Yes, there are various costs allowed as tax deductible against the rental income. So service charges is one mainly. Repairs and maintenance. And the question was specifically about communication tools.
Yeah, so think properties like admin and communication tools was the question. But I
So
suppose it's good to know for everything.
Yeah, even actually in our last webinar, we discussed what could be treated as tax deductible. Let's say you're overseas and you need to visit the property for specific reasons. Those costs could be treated as tax deductible, as long as they're wholly and exclusively related to the rental income and to the rental property. So if you have an argument to say that these costs are specifically related, I think maybe you're talking about buying a computer and managing the rent from your computer, then that would not be wholly and exclusively, unless you can argue that it's wholly and exclusively related to the rental property, then yes, but there's a large there's a diverse reasons for the cost that you can deduct from the rental income, and feel free to get in touch with me to clarify. But costs that are wholly and exclusively related to the rental income can be deducted.
And is that even if you're buying in your own name versus a company structure? It's both of them?
So if you buy in a company structure, then it'll be part of the costs of running the business. And if you buy in your own name, then we need to make sure that the cost is wholly and exclusively related to the rental property. So if you're flying from Dubai to London to visit the property, then that, because of maintenance issues or some legal issues, and it's wholly and exclusively related to the property, then that would be allowed as tax deductible.
Perfect. Thank you very much, Lawrence. Sophia, we got a question for you about refinancing property. A lot of our clients obviously come to us having owned properties, perhaps in the UK already, that they lived in previously and then have rented out, and they've paid off their mortgage or the majority of their mortgage, and perhaps want to look at what their options are there. The question is around the pros and cons of refinancing an outright property to fund a new investment. What would you say for that?
Well, I think one of the biggest pros is, of course, with liquidity, taking out that equity that's built up in that property. I mean, the beauty of holding onto a property is you've got that capital appreciation. So you buy the property for, let's say, £200,000 and it goes up to £400,000. There's that £200,000 in that property that you can then release. So you can release that capital raise and then reinvest it and grow a portfolio. And we always say that that's how portfolio landlords in the UK then, grow their portfolios, so to speak, and buy 3, 4, 5 plus buy-to-let properties, just leveraging and growing. So I think that's the massive pro. That's the biggest pro. Lawrence, you may be able to touch on it, but there may be tax benefits from doing so. Are there, from kind of releasing equity and offsetting some of that mortgage interest if it's in the company potentially? So yeah.
Okay. And do you find if clients have already owned property in the UK, do they tend to get favourable interest rates?
Yeah, absolutely. Because whilst you may not necessarily need a UK footprint to start off with, if you have a property in the UK, yes, you have that footprint, but not only that, the property has a track record of being rented out. So that gives the banks that added security that it's been rented for 12 months, 24 months. You've got an AST in place. So that can absolutely help. Yeah.
Okay, perfect. That's good to know. I think, again, a lot of our clients don't realize that they can utilize that existing equity. And it's something that we would always advise as well for clients of ours that have bought over the years that, have paid off a mortgage for a certain amount of time. One of the most efficient ways to build a portfolio isn't necessarily by having to use your liquidity to do so. It's by 1 buys 2 and 2 buys 3 through sort of organically that way, which is a great way to do it. Raj, a question on void periods, which is obviously something that people are often concerned about. You're obviously, expert within the Birmingham market, but, I guess it's applicable to city centres. I mean, what do you find as the average void periods for, if we're specific to 1 and 2 bedroom apartments, which what we look at, what do you typically find with that?
So I'd probably say in the summer, kind of June to September, October, a few days. Void periods don't really exist in the summer. I would say over kind of this period, over Christmas, you maybe I mean, you might only have a void period for a few days because people still do move over this period, but the activity is less. So you may have a void period of a few weeks, a month. And then kind of in, what we consider like the average months, like February, March, April, I'd probably say maybe 2 weeks. But it could be a lot less. But yeah, if you price the property right and you've bought the right property, then void periods really are not an issue. They're minimal.
Yeah, I think we all know the housing crisis in the UK is getting more and more extreme. It's sort of compounding each year. The fact that we don't have enough homes, the BBC reported, what was it, 25 people to one home in the UK for viewings. 25 people are viewing one apartment or one home, which is why void periods are sort of such a more of a rarity in the UK, and it is obviously such an important thing to consider. Do you see any difference between 1 and 2 beds from a void period perspective?
Um, Maybe slightly, maybe a bit more void periods on 2 beds, just because of the affordability issue that I mentioned in terms
Yeah.
of, rents have gone so high that less people can afford the 2 beds. But it's a very small amount, really. What I'd always advise to a landlord that is worried about void periods is why not get your tenancies in line with a summer renewal date? So if your tenant's ever moving out, your tenancy end date is always in the summer, and then you don't have that issue. Obviously, you might buy, let's say you buy a new build property and the completion's in December. Yes, and you might have then your first tenant and they request a 12-month tenancy. Now, of course, you probably would favour a 12-month tenancy um, over a 6-month, but why not suggest a 9-month tenancy in that scenario? At least then your property, if the tenant is going to move out, then they're moving out in the September time when the market's good.
Yeah, it's a really good point, and it's something that I don't think people consider that much, is that there are different sort of patterns in the UK between, when people are going to pay more for rent and when there's more people in the market. People don't want to move around Christmas. People prefer to move in the summer when they're a bit freer. So yeah, no, it's an interesting point and always something to consider. And then Raj, lastly for you, I mean, I think this is, again, it's an important part to understand, is furnished versus unfurnished. What do you find works best?
In city centres, definitely furnished. In suburbs, they're unfurnished. So if you take Birmingham, for example, in the Birmingham city centre, 90% of the apartments are furnished, and it's because it's a young professional market. They just want to move straight in, not have to worry about bringing furniture in. They're probably, have got a family home, live with their parents somewhere else in the UK, but they've got a job. Maybe they've graduated recently, they've relocated to Birmingham, and they don't have furniture. Then in the suburbs of Birmingham, it's more kind of family housing where tenants, have their own furniture, and then that would be an unfurnished market.
Absolutely, yeah, that's what we've always found. So no, it's again another thing for people to consider. Guys, we're over an hour now, just or on an hour. So I want to firstly thank everybody for their time. Thank you very much, Lawrence. Thank you, Sophia. Thank you, Raj. As we said, look, we've been privileged guys over the years. If you do want more information on each of the different aspects of what we talked about today, then please do get in touch. We're going to send an email around with everybody's contact details, so you'll be able to contact direct, or if you want to ask us to introduce you, then obviously we're happy to do so. We do have an offering for everybody in the Christmas spirit for December that has attended this webinar and our earlier one, that you do get a £1,000 contribution towards your legal fees for anybody that invests this month with Joseph Mews. So if you want to understand what our offerings are and how that can be utilized, then please do get in touch. I think the next slide is going to ask you if you'd like to book a meeting with any of our distinguished panelists. So please do select one. Obviously, you can select more than one if you want to speak to everybody. Let us know. If you just want to speak to Sophia or Lawrence, Raj, whoever it might be, then please do click on there. But yeah, I'd just like to finish again by saying thank you to all of you that have taken the time to join. Your feedback is obviously hugely appreciated when you'll have an opportunity to give that. We want to go into 2025 with doing these more regularly and just making sure that they're as useful as they possibly can be. So feedback is welcome. And again, thank you to Sophia, Raj and Lawrence for your time. And yeah, Merry Christmas to everybody.
Thank you.
Thank you very much, everyone. Merry Christmas.
Bye.